In finance, the efficient market hypothesis, also known as EMH, asserts that financial markets are informationally efficient. In consequence of this, one cannot consistently achieve returns in excess of average market returns on a risk-adjusted basis, given the information available at the time the investment is made. There are three major versions of the hypothesis: weak, semi-strong, and strong. The weak form EMH claims that prices on traded assets already reflect all past publicly available information. The semi-strong form EMH claims both that prices reflect all publicly available information and that prices instantly change to reflect new public information. The strong form EMH additionally claims that prices instantly reflect even hidden or insider information. Critics have blamed the belief in rational markets for much of the late 2000s financial crisis. In response, proponents of the hypothesis have stated that market efficiency does not mean having no uncertainty about the future, that market efficiency is a simplification of the world which may not always hold true, and that the market is practically efficient for investment purposes for most individuals. Beyond the normal utility maximizing agents, the efficient market hypothesis requires that agents have rational expectations, that on average the population is correct, and whenever new relevant information appears, the agents update their expectations appropriately. Note that it is not required that the agents be rational. EMH allows that when faced with new information, some investors may overreact and some may underreact. All that is required by the EMH is that investors' reactions be random and follow a normal distribution pattern so that the net effect on market prices cannot be reliably exploited to make an abnormal profit, especially when considering transaction costs. Thus, any one person can be wrong about the market. Indeed, everyone can be, but the market as a whole is always right. There are three common forms in which the efficient market hypothesis is commonly stated: weak form efficiency, semi-strong form efficiency, and strong form efficiency, each of which has different implications for how markets work. In weak form efficiency, future prices cannot be predicted by analyzing prices from the past. Excess returns cannot be earned in the long run by using investment strategies based on historical share prices or other historical data. Technical analysis techniques will not be able to consistently produce excess returns, though some forms of fundamental analysis may still provide excess returns. Share prices exhibit no serial dependencies, meaning that there are no patterns to asset prices. This implies that future price movements are determined entirely by information not contained in the price series. Hence, prices must follow a random walk. This soft EMH does not require that prices remain at or near equilibrium, but only that market participants not be able to systematically profit from market inefficiencies. However, while EMH predicts that all price movement is random, many studies have shown a marked tendency for the stock markets to trend over time periods of weeks or longer, and that, moreover, there is a positive correlation between degree of trending and length of time period studied. Various explanations for such large and apparently non-random price movements have been promulgated. The problem of algorithmically constructing prices, which reflect all available information, has been studied extensively in the field of computer science. For example, the complexity of finding the arbitrage opportunities in pair betting markets has been shown to be NP-hard. In semi-strong form efficiency, it is implied that share prices adjust to publicly available new information very rapidly and in an unbiased fashion, such that no excess returns can be earned by trading on that information. Semi-strong form efficiency implies that neither fundamental analysis nor technical analysis techniques will be able to reliably produce excess returns. To test for semi-strong form efficiency, the adjustments to previously unknown news must be of a reasonable size and must be instantaneous. To test for this, consistent upward or downward adjustments after the initial change must be looked for. If there are any such adjustments, it would suggest that investors had interpreted the information in a biased fashion and hence in an inefficient manner. In strong form efficiency, share prices reflect all information, public and private, and no one can earn excess returns. If there are legal barriers to private information becoming public, as with insider trading laws, Strong form efficiency is impossible, except in the case where the laws are universally ignored. To test for a strong form efficiency, a market needs to exist where investors cannot consistently earn excess returns over a long period of time. Even if some money managers are consistently observed to beat the market, no refutation even if strong form efficiency follows. With hundreds of thousands of fund managers worldwide, even a normal distribution of returns should be expected to produce a few dozen star performers.